Welcome back. You're watching us here on Chartbusters on CNBC-TV18. CEAT, that's the stock on our radar. The company reported its numbers where revenues were below expectations, margins were under pressure, and we had the raw material costs which spiked as well. The company announced a 450 crore rupee capacity expansion plan for its Chennai plant. Arnab Banerjee, who's the managing director and CEO of the company, now joins in. The stock lower by about 1.5%. Arnab, remember having this conversation with you just about a fortnight ago, where you said that there are some challenges when it comes to raw material, and you see expectations coming by only, expectations of an increase coming by only post the second quarter. Was this magnitude of impact expected? Because no one on the street was working with this number. And how much worse can things get before they get better? And by when do you expect them to get better?
Yeah, good morning. Pleasure to be here. We expected about 0 to 1% kind of benefit in raw material, which has not come through. It is flat, more or less, because of the inventories that we carry. Our growth has been pretty robust. If you have seen 11.5%, so that we will continue to grow in double digit right through this year and maybe accelerate from here. So that part is sorted. Domestic growth has happened very, very well, both OEM and replacement. International business is where we had a flat growth. There were headwinds in almost all the markets because of geopolitical uncertainties, tariff uncertainties. The trade was not stocking up because of these uncertainties. And now looking at the future, the international business where we had headwinds is going to be slightly better in Q2 because we have view of the order book that we have, the seasonal order book of Q2, especially from Europe has all come in. So we expect Q2 to be better in international. Domestic growth in OEM as well as replacement is going to be robust. As far as margins are concerned, Q2 definitely there will be a flow through because the inventory consumption has happened with 11.5% growth in Q1. So we expect much more benign and lower raw material cost in Q2, and we expect to hold our pricing. So the margin outlook is better.
So what is the outlook?
Well, it all depends on many things, right? Exactly how much the raw material cost will come down by. We have maintained that we don't want wild swings in margin. So our margin in the last 2 quarters have been 11.5 and 11 roughly at EBITDA level. So the change in whichever way will also be not a very big quantum jump. It will be in a narrow band, but it will improve.
Okay, all right. Hi, Mr. Banerjee. Good morning and good to see you, Ben. Couple of quick questions. So double-digit revenue growth for the year is on the cards, right?
Should happen.
All right. Exports are going to recover. What about on the domestic front? How is demand shaping up? Because the last time we chatted, you were talking about it being a little bit tepid. And though things have been a little bit subdued, have you gained market share?
Yes, we have gained market share in replacement in Q1 in both motorcycle, scooter, as well as in passenger car tires. In passenger car tires, we have been gaining pretty good in the premium end of the passenger car tire as well. Truck bus radial has been a steady performer. Coming to the demand side, in OEM first, you have seen YOY, there's a growth in MHCV. Though QOQ, they have degrown, but that happens always. Passenger is growing at low single digit, and the growth rate of two-wheelers is also coming down, especially motorcycle. That's the OEM part. We are maintaining our share of business and growing massively in passenger because the approvals are now coming through in the higher rim sizes. So we will continue to grow well by increasing share of business in OEMs. Replacement, the demand of truck bus segment is about mid-single digits. Here we are going steady. The passenger is subdued in replacement because of lower growth in the urban segment. That demand softness continues and will continue for some more time. Two-wheeler backed by rural and scooter growth is pretty robust, and we have gained market share here. So overall, I think between OEM and replacement across these 3 segments, we expect to have double-digit growth in the coming 3 quarters as well.
All right, double-digit growth in domestic business. What about international? That's about 1/5 of your revenues. Are we out of the woods there?
We can't say right now because after August 1, we'll have to see what is the tariff for India as well as the relative tariff of India vis-a-vis the other companies, other countries. That relates to our growth prospect in the US. As far as Europe is concerned, I think the uncertainty has lessened a little bit because our order book for Q2 is very good. But we don't have very good visibility of Q3 and Q4 at this point of time. Q2 definitely is going to be better than Q1.
All right. And what about, the incremental capacity addition that you're doing? Because I remember you going down this huge capex plan, wanting to invest 10% every year for growth, or invest for 10% growth every year, but not at the cost of your ROCE. We have seen an improvement in your ROCE over what it was, say, 3 years ago. But because of this incremental capex, that would be compromised for a bit, right? So what are the lower levels here, and by when do you expect them to improve?
Our ROCE's post-tax is still in double digit, and it is going to improve. This capex is going to improve that, because we do capex in very, very small quantities so that ramp up of capacity is fast. We have very clear view of the demand. This is going to aid the premium end of the passenger car tires market in domestic OEM as well as replacement. And we are seeing market share gains positively in this segment. Our capacity utilizations are 90% plus. So, and this is very, very bite-sized, 450 crores, which will not really impact a company of our size to any significant impact on ROCE. And the international business, whenever the bounce back happens, let's say even if it happens after 2-3 quarters, it's going to add to the margins in this particular segments of passenger car tires.
All that, Mr. Banerjee. Final question before we let you go. We've enjoyed a lot of your advertising lately, especially the ones with the wordplay, Slippery Road and Girija Chowk, etc. How much more are you going to spend on ads this year versus what you did last year?
Well, Q1 has been heavy because of our IPL presence also, the strategic timeout, and this advertising is working well. We expect to maintain a 2.1, 2.2 to 2.5 kind of ratio as percentage of sale. If you see, we would like to maintain this ratio right through the year.
All right, Mr. Banerjee, we'll take a strategic timeout with you now. Wish you good luck for the remainder of this year and hope things improve.